BlackRock chief investment officer warns that the Fed may pause for an extended period of time after the next rate hike. President Biden doesn't even have 50 votes for his clean debt limit hike. And South Africa is warning. They're warning Russia that Putin would be arrested at the summit. President Biden is quietly, secretly backing a behemoth natural gas project despite the pleas from climate activists. And the S&P 500, the Florida housing market, and the banks are in for a world of hurt, courtesy of none other than Fed Chair Jerome Powell. Welcome back to the channel, guys. It's Ron here. Hope you guys are doing very well. If you're stopping by the channel for the first time, please consider subscribing to the channel. And while you guys are at it, go ahead and smash that like button. I really would appreciate that. So guys, let's go ahead and jump into today's story. So the Fed may pause for an extended period of time after this rate hike. This is according to BlackRock. And President Biden doesn't even have 50 votes to cover his debt limit. So after the House Republicans have passed the legislation that raises the federal government's debt limit, White House Press Secretary Karine Jean-Pierre is telling reporters avoiding default is Congress's responsibility, and they should act on it without precondition, as they have done in Democratic and Republican administrations. Basically, the Biden administration, President Biden, as well as Karine Jean-Pierre, and essentially everyone who supports him, is basically saying, hey, we need to raise this debt limit. We need to be able to spend more money. We need to be able to print more money, turn on quantitative easing, let the Fed do its thing. That's the way I'm interpreting it. And setting aside for the moment that this statement is false, according to politics here, politics.au, the debt limit has almost always been raised in conjunction with other legislative priorities. Basically, backtracking a little bit on what Karine Jean-Pierre has said. Wouldn't be the first time, right? Now, moreover, they're saying that it has become exceedingly clear that the Democrats in the Senate don't even have 50 votes, let alone the 60 votes that they would need for this clean debt hike, this clean debt limit that President Joe Biden is insisting on. And Senator Joe Manchin, of all people, said that he supports the negotiating with House Republicans on this debt limit legislation. Senator Kevin McCarthy did his job, and he passed a bill that would prevent debt, that would prevent default, and finally begin to rein in federal spending. This is what Joe Manchin says. And he goes on to say, while I do not agree with everything proposed, it remains the only bill moving through Congress and would prevent default that cannot be ignored. Well, I'll tell you what, guys, we definitely need to be avoiding default. If we're seeing a recession by the end of this year, we're seeing that the U.S. dollar could be losing its global reserve currency status. Can you imagine what would happen if we did not make good on our debts as a nation, as a U.S. economy? This would be the very epitome of an economic collapse. So moving on, the Fed actually may pause for an extended period of time after this next rate hike, at least according to BlackRock. So a very surprising early debt ceiling deadline and recent regional bank woes probably will not keep the Federal Reserve from raising interest rates at its policy meeting on Wednesday. So like literally in just a few hours. So the Fed will very likely hike its interest rate benchmark 25 basis points to a target range of 5% to 5.25%. And this is according to Reader, which is BlackRock's chief investment officer of global fixed income. And he's also the head of the firm's global allocation investment team. So he's, in other words, he's a big guy. He's a big guy, manages billions of dollars, and he might know what he's talking about here. Goes on to say that then I think we're going to go on a pause for an extended period of time and let the prior rate hikes marinate through the system. So this is actually going to be pointing toward a shock toward the central bank. And we're going to have to see how this plays out. We're seeing inflation, according to the CPI reports that are coming out. It looks like CPI inflation is coming down. But guys, this doesn't mean that prices are actually getting less expensive in the grocery stores. We're not seeing prices come down in really the bread and butter areas of consumerism. We are seeing a little bit of price sensitivity, a little bit of pricing softness in the housing market, especially the Florida housing market. I've been seeing a lot of homeowners actually bringing down their prices, which are, for their homes that are listed on Redfin, Realtor.com, Zillow.com. And the thing is not only are higher interest rates from the Federal Reserve hampering homeowners from being able to sell their homes and from home buyers from being able to afford to purchase these homes, But on top of that, Florida homeowners have been hit with some very unexpected expenses, including higher HOA fees, multiple homeowner insurance or insurance companies that insure homes pulling out of the state of Florida. You've got natural disasters such as Hurricane Ian and a whole host of others that just devastated the whole state and drove up insurance premiums. And let's not even forget about taxes. So there's a ton of things working against the Florida housing market right now. Now, President Putin, or I guess he is. So Putin would actually be arrested. According to South Africa, they're warning Russia. They're warning Russia that Putin would be arrested at the summit. Now, South African officials feel a legal obligation to arrest Russian President Vladimir Putin on site on behalf of the International Criminal Court if he attends a diplomatic summit, according to a local press leak. They went on to say, quote, "We have a legal opinion that spells out the options." A South African official told the Sunday Times, there is no option not to arrest Putin if he comes here. We have to arrest him, end quote. So Putin drew an indictment for war crimes in the Ukraine last month when the ICC prosecutors and United Nations investigators issued separate findings that Russian officials have orchestrated the forced deportation of Ukrainian children. The arrest warrant puts South African President Cyril, I can't even pronounce his last name, in a difficult position because South Africa is treaty bound to support the ICC, but it also hosts the BRICS summit in August, which is a bloc of developing countries historically dominated by none other than Russia and China. All right, so that's going to get a little bit interesting to say the least. Now, the S&P 500 is actually slated to be in for a world of hurt, courtesy of none other than Fed Chair Jerome Powell. So the stock markets are overwhelmingly optimistic that the Federal Reserve will quickly switch to cutting rate hikes. A panel of financial services executives and large global investors are warning about. They are warning about this next Fed hike and what it's going to be doing to the markets. So we should actually be seeing this rollout effect. It's going to affect interest rates for mortgages, interest rates for credit cards, the stock market, ETFs, index funds, mutual funds, you name it. The Federal Reserve is expected to raise interest rates for a 10th time at its May 2nd and 3rd meeting. So they already had a meeting earlier today, or I should say technically yesterday, and they are going to be having another meeting on May 3rd later on today. And so there's a lot of uncertainty in terms of what comes after this, but the U.S. stocks are pricing a significant easing in monetary policy in the near term, a scenario that panelists are definitely expecting. Now, financial assets are signaling a somewhat of a run-of-the-mill economic slowdown, but expecting the Federal Reserve to significantly ease monetary policy, which leaves the markets primed for disappointment. Now, here's the thing, guys. The markets have actually run up tremendously. If you're looking at the S&P 500, for example, we're within less than 5% of reaching all-time highs on the S&P 500. If you look at the NASDAQ, you look at the Dow Jones, both of these indices are roughly in the same ballpark. They're all trying to breach that all-time high, which was hit back in January of 2022. Now, if this happens, we could very well have a bull run in the middle of a recession. So this will be the epitome of the stock market not at all paying any attention to the current economic situation that we're in. Now, inflation, she said, isn't likely to come down sharply enough to let the Fed ease off of its inflation fight. Add to that, you got the credit crunch as banks curb lending, rising rates pushing the economy into a more severe downturn, and stock investors stand to be disappointed. So, well, here's the thing. Stock investors are very forward-looking. I don't know if they'll really be disappointed. Now, if they are, we could very well see one of the greatest stock market crashes in history. But if not, we could very well see the initial start of the next bull run. So it's going to be very interesting to see what happens next. So, and many people are just completely outraged by President Biden's new mortgage rule, which is pushing buyers with good credit to get bent over. This is a recipe for disaster. So, according to the Biden administration's redistribution, I should call it the Biden administration's mortgage redistribution of wealth plan, goes into effect. Real estate leaders have signaled it's one more boot on our neck in the housing market. Quote, I think that putting people in a position to take a place that they really can't make happen is a recipe for disaster. Okay, yeah. So now, under the new rules, from the Federal Housing Finance Agency, also known as the FHFA. It is set to take effect as of 2 days ago, May 1st. Borrowers with lower credit ratings and less money for down payment will qualify for better mortgage rates than they otherwise would have. So, I'm not saying like we shouldn't help out people who are a little bit less financially capable at the moment. But at the same time, it is literally a complete slap in the face for people who have been hustling and grinding and saving extra money and paying their bills on time and being great stewards of their money as they build wealth. It's definitely a slap in the face. So a person's credit score is one of the most important indicators of credit worthiness for lenders. It's helping to determine if a prospective borrower will qualify for a loan and what interest rates will apply. Now, according to recent analysis from bankrate.com, somebody with a below average credit score of 640 points seeking a $350,000 mortgage with 20% down paid $10,500 in mortgage acquisition mortgage related fees before new regulations. Keep that in mind, $10,500. Now they're going to pay $7,825. So now on the flip side, somebody with great credit, a prime credit application or applicant, somebody with 740 credit score exploring the same deal paid $1,750 in fees before the FHFA's new rules, but is expected to now pay more than $3,062. Now I want you guys to look at this comparison here. You got great credit, $1,700 in fees. You got bad credit, $10,000 in fees. That's how it was. Now, if you got bad credit, your fees were reduced to $7,800. And if you have good credit, your fees were increased to $3,062. To me, it sounds like they wanted to help the lower credit score, lower credit worthy individuals with, less money available for down payments to be able to get in these houses a little bit easier. So what they did was they subsidized the less qualified buyers with higher fees. In other words, discount the less qualified buyers' fees and pass those costs onto those who have higher credit scores and essentially have more money and can absorb that extra cost. So I'd love to hear from you guys. Do you think that this is fair? Does this piss you off, or do you think that this is the right thing to do? Me personally, it could do one of two things. Number one, by reducing the expenses of mortgage acquisitions by less qualified buyers, that could technically increase the number of buyers on the market and actually help to stabilize the housing market because there would be more people who could potentially buy. So it would increase the buyer pool from that respect. Now, the flip side to that is people with great credit could be like, you know what? I know it's only an extra $1,300, $1,400 in mortgage fees, but I'm pissed off. I don't want to pay it. And maybe they back out of the market. But, who knows? So let me know what you guys are thinking. Drop me some comments down below. I love hearing from you guys, seriously. And also for the very best way to invest in gold, hit the links in the description down below this video. But I appreciate you guys checking out the show. Drop a like if you made it this far. Consider subscribing to the channel, and I'm going to see you guys on the next one. Be safe.